Hi everyone, welcome to InfoCraze. Have you ever wondered why the value of a car drops the moment you drive it out of the showroom? That's because of depreciation. In this video, we will learn the basics of depreciation, which is a very important topic in accounting. This will be useful for students and accounting professionals preparing for job interviews. What is depreciation? In general terms, depreciation is the reduction in the value of an asset over time due to factors like wear and tear, obsolescence, or passage of time. Depreciation is applicable to tangible assets like plant and machinery, vehicles, etc. From accounting perspective, we need to define depreciation in a more technical manner, which says that depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. Let's focus on the two key words here: depreciable amount and useful life. In order to have a clear understanding of these terms, let us take an example. Assume a company called Ritz Engineering has acquired a machine on 1st April 2024 at the cost of rupees 20 lakhs, which will be used for business operations for many years. Remember, we need to consider the cost of the asset and not the purchase price. What does that mean? Cost of an asset includes the purchase price, non-refundable import duties and purchase taxes after deducting trade discounts and rebates, and all directly attributable expenses like transportation, installation, commissioning, testing, trial run, etc., which are necessary to bring the asset to its intended use. Now, imagine that the useful life of the asset is 6 years. What is meant by useful life? It means that the estimated period over which the asset is expected to be used productively by the business is 6 years, after which it will become obsolete, inefficient, or uneconomical. At the end of useful life, assume that the asset can be sold at an amount of rupees 2 lakhs after deducting selling costs, if any. This is called the residual value or salvage value, which is the estimated amount that an asset will be worth at the end of its useful life. For the current example, since it's rupees 2 lakhs, rupees 20 lakhs minus 2 lakhs, that is rupees 18 lakhs, is the depreciable amount of the asset, which is the portion of its cost that is allocated as depreciation over its useful life. Thus, cost of asset less residual value is the depreciable amount, which is rupees 18 lakhs in the current example. This amount will be allocated equally over its useful life. Thus, annual depreciation is equal to depreciable amount divided by the useful life of the asset, which means 18 lakhs divided by 6, that is rupees 3 lakhs, will be depreciated every year. This is called straight line method of depreciation, where an asset's depreciable amount is allocated equally over its useful life. In straight line method, there is equal depreciation expense every year, and hence the book value of an asset gets depreciated uniformly over the years during useful life. Once the depreciation amount is determined, we need to decide on the process of accounting depreciation in the financial books. There are two main methods for accounting of depreciation: direct method, which involves reduction from asset account, and indirect method using accumulated depreciation account. In the direct method, depreciation amount is credited to the asset account every year, and the asset account is carried at a historical cost less depreciation. Thus, depreciation is directly deducted from the asset's value in the asset account itself, and the asset's book value keeps reducing every year. Thus, the depreciation will be accounted as in this chart, where the machinery account value keeps reducing each year as depreciation is charged directly to the asset. Hope this is clear till now. So, the accounting entries passed at the end of every year would be debit depreciation account, credit asset account. Now the depreciation will be transferred to the profit and loss account. Therefore, debit profit and loss account and credit depreciation account. In our current example, the accounting entries for a year would be debit depreciation account rupees 3 lakh, credit machinery account rupees 3 lakh, and then debit profit and loss account rupees 3 lakhs, and then credit depreciation account rupees 3 lakhs. In the indirect method, depreciation is recorded separately in an accumulated depreciation account and the original asset value remains unchanged. This method is also called contra asset method, as the accumulated depreciation account features as a contra asset account which offsets the value of the related asset. That is, it appears as a deduction under the asset section of a balance sheet. The accumulated depreciation account shows total depreciation charged over the years while the original machinery account remains unchanged at rupees 20 lakhs. So, the accounting entries passed at the end of the year are debit depreciation account, credit accumulated depreciation account, and then debit profit and loss account, credit depreciation account. Hope you are clear on the accounting processes for depreciation. Now we will briefly go through the different methods of calculating depreciation. Some of the important methods of calculating depreciation are straight line method, written down value method, units of production method, sum of years digits method. Out of these, the first two, straight line method and written down value method, are the most commonly used methods. The depreciation method that we studied earlier for RITS engineering is the straight line method. So, we will now go through the other most commonly used method, that is the written down value method, also called as the WDV method in short. The written down value method, also called the diminishing balance method or reducing balance method, is a method of depreciation where a fixed percentage of depreciation is applied to the book value of an asset at the beginning of each year. This method is commonly used for plants, fixtures, etc. Under this method, the annual charge of depreciation decreases from year to year. So, there is higher depreciation in earlier years and lower in later years. This method is based on the assumption that the cost of repairs will increase as the assets get old. Therefore, depreciation in earlier years is high when the cost of repairs is expected to be low, and depreciation in later years is less when the cost of repairs is expected to be high. Thus, under written down value method of depreciation, the chart for book value of an asset year on year is not a straight line like in the straight line method. Further, under this method, the value of an asset can never be extinguished completely, which happens in the straight line method explained earlier. As shown earlier in the straight line method, accounting of depreciation for written down value method can be done in direct method as shown here and also by the indirect method as shown in the next chart. Hope you have now got the basic understanding of depreciation. If you want to know more about the other methods of depreciation, that is units of production method and sum of years digits method, please write other depreciation methods in the comment section. I will cover those in a separate video. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Also subscribe to my channel for many such interesting videos. If you have any question, please put your query in the comment section. Thanks for watching.